In today's video, I want to examine one of the reasons why um, typically retail traders, amateur traders um, don't make money, not necessarily lose money, but don't make money. I've kind of touched on this many times in the past. Markets tend to go through periods of strong trends like we see here, followed by a period of consolidation. So a period of easy trading followed by a period of difficult trading. Then you have a period of easy trending trading and a period of sideways consolidation, difficult trading, hard to make money. So this is what happens to the, a lot or the majority of traders, especially retail traders that are driven by their emotions. Um, when we get a strong trending move, first off, they're late to accept it or recognize it. And so instead of getting in at the bottom, a contrarian trader, like we try and do in the S&T, we try and get in at these bottoms. Most traders, their emotions won't let them get in at the bottom, and it's not until half the move has gone by before they're convinced that the move is for real. So they miss a big chunk of the rally, and then as the rally progresses, their emotions become um, more and or their emotions convince them more and more that the rally is for real and it's going to continue. And then you hit a point where the market has gone far enough, you kind of run out of buyers, and then you have to transition into this sideways or down period. And what happens is traders bring this same mentality of you know what was happening here, the strong trending move, easy to make money, you just buy and hold. That mentality uh, spills over into this difficult consolidation or corrective phase, and so they want to use the same strategies in this um, environment as they used in this trending environment, and of course it doesn't work. And this is I've noted this before. This is when I see uh, subscribers get frustrated and cancel their subscription. I've said before these people are a great contrarian signal for us. When these people get frustrated, they want the market to move in their time frame instead of them moving in the time frame of the market. So what happens is they're trying to force trades into a market that's either correcting or is choppy. This is an example of a choppy market. And we saw the same thing here. When the market, again, uh, their emotions prevented them from buying down here. They probably let most of this rally pass them by. And then when they were ready to buy and hold, the market transitioned into this triangle pattern. And I witnessed this um, extensively during this period. Traders trying to force long trades into this choppy sideways pattern. Let me convert over to the minors here because this is very clear. So this is what we were in here. This very choppy back and forth, even daily, but big swings back and forth, back above and below the 10-day moving average. Very tough to make money. But traders wanted a repeat of this trending move quickly, and so they were trying to force long trades or short trades into this choppy environment, and that's just a recipe for losing money. And if they're heavily leveraged, which is what most retail traders, one of the mistakes they make, they get heavily leveraged in a choppy sideways pattern, and they do severe damage to their account. And then invariably what happens, let me go back to gold. Invariably what happens is eventually the corrective phase or the sideways phase ends, and then you start another trending phase. But this is what happens to most traders, is eventually they become conditioned to expect disappointment and whipsaws. They become conditioned to this environment. And so now they're prepared to take profits very quickly on their long trades, or maybe they're trying to play short-term short trades as well, and so they are not prepared for the next trending move. And when it starts, their mindset is still stuck in this kind of a trading environment, which doesn't work in a trending environment. In a trending market, it will cost you money in a trending market. And in this kind of market, or this kind of market, the way to make money is to buy low and then hang on. In this kind of market, you either need to be on the sidelines and get out of the whipsaw and the grinder, or you have to be a very short-term trader, taking profits on long and short trades very quickly, and that of course just doesn't work in a trending market. So we saw this choppy phase here as gold went through the triangle. I saw a lot of traders trying to force directional trades into that market. They were just getting chopped up, losing money. If they ignored me and were using leverage, they were doing severe damage to their account during this period. And now they have become conditioned to expect that. So now what I'm seeing as we transition out of this sideways into another trending move is I'm seeing them again stuck in this whipsawing, churning mentality, and they're trying to use the strategies that work during this kind of an environment in a market that is probably transitioning into a strong trend again. So they tend to want to take profits very quickly once the market gets overbought. A strategy that would have worked in this whipsawing environment, but will fail miserably and cost them a lot of money now that the market is almost certainly transitioned now into a trending market. So, this is what I do in the SMT. I try and teach people how to, the first concept you have to learn is that trending markets are followed by, trending easy markets are followed by difficult markets, sideways consolidations, corrections, and then those eventually give way to trending markets again. When you're in a sideways consolidation, recognize it early, get on the sidelines, don't waste your mental capital, don't waste your capital trying to trade in these, wait for the trend to start, and then when the trend starts, be prepared to jump on it and hold your positions. In that kind of environment, the way to make money is to buy and hold firm and let the trend run its course. I can teach some people to do this. Some people are just hopelessly too emotional, and they will never learn, never be able to learn this principle. And like I said, these are the people that end up quitting and getting knocked out, canceling their subscriptions during these sideways consolidation phase, because they want the market to move in their time frame instead of them adapting to the market's time frame and just waiting patiently for the trend to start.